The provisioning coverage ratio (PCR) is a critical financial indicator used to assess the health and resilience of banks, particularly in managing non-performing assets (NPAs). Provisioning coverage ratio (PCR) meaning provisioning coverage ratio (PCR) is the percentage of non-performing assets (NPAs) that a bank sets aside from its profit or capital to cover potential losses. The percentage depends on the quality of assets. Worse the asset quality, higher the PCR required. It is calculated as PCR percentage equal to provision for non-performing assets plus gross non-performing assets multiplied by 100. Provision for NPAs are fund set aside to cover potential losses from loans that may not be recovered. Gross NPAs are loans overdue for more than 90 days. A higher PCR indicates that the bank is better prepared to absorb potential losses from bad loans, helping maintain financial stability. Example: suppose a bank has gross NPAs equal to ₹100 crore and provision set aside for NPAs equal to ₹70 crore, then PCR percentage equal to 70 divided by 100 multiplied by 100 equal to 70%. This means that bank has provisioned 70% of its bad loans. A higher PCR like this shows that the bank is well prepared to absorb losses even if some loans cannot be recovered. Provisioning coverage ratio (PCR) significance. The provisioning coverage ratio (PCR) is significant for multiple reasons. Financial health of banks. A higher PCR suggests that the bank has adequately provisioned against bad loans, reducing the risk of sudden financial shocks. Investor confidence. Investors and depositors view a higher PCR positively as it indicates prudent risk management and lower vulnerability to credit losses. Regulatory oversight. The Reserve Bank of India mandates minimum provisioning norms, and PCR is a key tool to monitor compliance. Economic stability. Banks with robust PCR levels are better equipped to handle stress sectors during economic downturns, thereby supporting overall financial stability. Factors affecting provisioning coverage ratio (PCR). Quality of loans. Banks with a higher proportion of risky loans may need to maintain a higher PCR. Regulatory requirements. RBI sets minimum provisioning requirement for different categories of NPAs. Economic environment. In periods of economic stress, banks tend to increase provision to safeguard against rising NPAs, thereby increasing PCR. Banks' risk appetite. Conservative banks maintain a higher PCR to protect against uncertainties, whereas aggressive banks may keep it lower to report higher profits. Limitation of provisioning coverage ratio (PCR). While provisioning coverage ratio (PCR) is an important metric, it has some limitations. Does not reflect actual recoveries. High provisioning does not guarantee that bad loans will be recovered. PCR does not distinguish between recoverable and unrecoverable NPAs, meaning a high PCR could be masking poor loan recovery efforts rather than reflecting genuine financial strength. Profitability impact. Higher provision reduce the reported profits of banks, affecting investor perception in the short term. Comparability issues. Different banks may follow varying provisioning practices, making direct comparison difficult.